What's up, guys? Welcome to Invest Today. My name is Jack. So in the last video, we talked about PE ratio. Now today, we're going to build upon that and talk about the PEG ratio, or the PEG, and that's price to earnings over growth ratio. And we're going to talk about what makes it a little bit better of a ratio compared to PE, and like who should use it, what's a good PEG ratio to have, and we'll go into all that today. So again, it takes the PE ratio, which we talked about in the last video. Please go take a look at that right now if you have not already, and it divides it by the company's expected growth. Now, you can already see one problem with this is that expected growth doesn't always turn into actual growth. And we'll go in a little bit of, about that later in depth about advantages and disadvantages of PEG ratio. So a PE is higher for companies with higher growth rates. And, like I said in the last video about PE, the market's trading around a 25. But if it's a high growth company, it's going to have like a PE of maybe like 80 or 100, 120. It's going to look ridiculous, especially from a value investor perspective. And maybe someone might avoid a great company because they have such a high PE. But it's just really because they're growing so fast. They're a newer company or such. So again, they're going to look overvalued in poor investments, but when you look at a PEG ratio, you're factoring in the expected growth rate. So it's better for companies, like comparing companies with different growth rates or companies in different sectors. Now, if I compare PE ratios of like a Toll Brothers to an Amazon, it looks ridiculous. Amazon trades at like a 79 and Toll trades at like a 6. It's going to make Toll Brothers look like a much better investment, where if you look at the actual, what the share prices have done, Amazon's up 60% and Toll's down like 20%. So it doesn't really add up. So that's where a PEG ratio would come in. We can compare companies from different sectors with different growth rates. That's all that PEG really means. Now, PEG was popularized by Peter Lynch. He wrote a book about it, and it kind of made it very popular. And he stated that when a company is fairly valued, the PEG would be 1. Nice flat 1.00. And, so let's take a look at an example. If you're growing at 40% per year and you have a PE ratio of 40, that'll be a 1-to-1 ratio, and that'll equal 1 PEG. Therefore, meaning the company is fairly valued by this metric. Now let's talk about some issues, because, I use PEG and PE a lot when I'm looking at my companies, but there are some issues that you should be aware of. Growth rate is subjective for the future, and it needs to come from an impartial source. So you really need to check when it says like expected growth. Now, is this coming from a company, or is this coming from an outside, third-party analyst firm? They're probably going to give you a little different numbers. Now, if they align, great. But you really have to make sure you know where that expected growth is coming from, because companies kind of, maybe some companies are a little conservative and it looks like their growth, they expect a little bit less than what they actually do. Some companies might try to come out with a growth rate that they know they can't hit, but it might attract, some investors. So really make sure you know where you're getting your expected growth coming from, because again, expected growth doesn't always turn to actual growth. Now, it doesn't factor in as well for economic growth. A high PEG for years is something to be a little leery of, because it's either a highly profitable company that probably makes a great investment and it's growing very rapidly, or it's a scam. And especially if the growth is a flat number. Now, this happened in the Bernie Madoff scheme. His returns and his PEG ratios would be like a 4 or a 2. They'd be like these random flat numbers, and the GDP of the economy would fluctuate, and his would remain the same for years. It turned out that's a good sign of a scam, kind of, that something's going on fishy with that company. So when I look for PEG ratios, I like 1 and below. Now, I own companies, 1.5, 1.6. That's, they get up there, but Jim Cramer actually has a rule: when it gets over 2, probably take some profits. I don't like it. I get nervous personally when it gets over 2. 2 typically means it's overvalued compared to where its growth is at. So I really like I won't do anything really above 2. So looking like 1.8 is a great investment, 0.6, 1.5, those are all fine numbers. 2 is kind of my top limit, so please take a look and kind of be leery about it. But a PEG ratio is great for value investors. It really allows us to go one step further than PE ratio and compare companies again across sectors and with different growth rates. And it's very important when you're actually trying to find a great investment. Thank you, guys. That's all I have. Please click the subscribe button right here. Throw me a like, throw me a comment. What are some other metrics you want to see me look at in the future? Thank you, guys, and I'll see you next time.